$60,000 just vanished from a policy surrender you thought was a clean exit. Here's what happened. Your insurance agent quoted you the surrender value, but they left out the IRS tax bill that follows. Under IRC Section 72E, modified endowment contracts don't work like normal investments, and most professionals don't find out until it's too late. Stay with me for the next 4 minutes, because by the end you'll know exactly what the IRS code says, how to calculate your actual tax liability, and why agents stay silent on this penalty structure. Let's start with the wrong belief most professionals carry into a surrender decision. I bought this policy 10 years ago. It's grown to a $500K surrender value. I'll cash it in, owe tax on my gains, and pocket the difference. That math seems simple. But the IRS code creates a hidden 20% penalty that agents almost never mention, and it changes the equation entirely. Here's the correct reality. A modified endowment contract is defined under IRC Section 72E11 as any life insurance contract that fails the IRS's 7-pay test. In plain English, if you put in too much money too fast in the first 7 policy years, the IRS reclassifies the entire contract as a MEC. Once it's a MEC, surrendering it before age 59.5 triggers 2 separate tax hits, not 1. This is the moment most agents go silent. First, ordinary income tax on your gains. Second, a 20% penalty on those same earnings. Let me show you the math with a real example, because the numbers get uncomfortable fast. You purchased a $500,000 whole life policy in 2015. Your total premiums paid, cost basis, were $350,000. Today, the policy has grown to a $500,000 surrender value. Your gain is $150,000. Now you surrender it. Your insurance agent tells you you'll net about $500,000 minus surrender charges. But that's incomplete. Under IRC Section 72E, the IRS treats this as a taxable distribution. You owe ordinary income tax on the $150,000 gain. If you're a high-income professional in the 37% federal bracket, that's $55,500 in federal tax alone. But it doesn't stop there. The IRS also applies a 20% penalty on the earnings portion. That's 20% of $150,000 equals $30,000 additional penalty. Add in state income tax at 5%, and you're looking at another $7,500. Total liability, approximately $93,000 before any other considerations. Your net from a $500,000 surrender value just dropped to roughly $407,000, an 18.6% reduction from what the agent quoted. That's the delta. That's why agents stay quiet. But there's another layer most people miss. If you're in a high-income bracket, say $300,000 to $500,000 annually, the 8% net investment income tax under the Affordable Care Act also applies. On a $150,000 gain, that's an additional $5,700. Now your total liability climbs to approximately $98,700. Your net drops below $401,000. The math just got worse, and your agent still hasn't mentioned any of this. Now, the deeper reason agents don't warn you: most life insurance agents are not tax professionals. Their compensation comes from the sale or the surrender transaction, not from the aftermath. Mentioning a 20% penalty and 37% federal bracket doesn't help close the surrender conversation. It creates friction. So they quote the surrender value and move on. The client discovers the tax bill 6 months later when they file, or when they call their CPA asking why their $1,099 is so large. By then, the money's already gone, and the decision is irreversible. Research into IRS Publication 539 and Notice 2009-34 confirms this treatment. The publication explicitly states that MEC distributions are taxed under Section 72E ordering rules. Gains first, then basis return tax-free. The 20% penalty applies to all distributions before age 59.5, unless you qualify for one of the narrow exceptions: substantially equal periodic payments under Section 72T, disability or death. For professional earning $200,000 to $500,000 annually, a single $500,000 surrender could drain $85,000 to $100,000 in unexpected tax and penalty. But the real cost extends further. Over 20 years at a 6% annual return, that capital would have compounded to $190,000 to $320,000 in additional wealth. Gone. This is why the decision to surrender requires more than the agent's quote. Here's what you should consider before you surrender. First, verify whether your policy is actually a MEC. Pull your original policy illustration and check if premiums exceeded the 7-pay test limit. Second, calculate your cost basis, the exact amount you've paid in premiums to date. Third, get a current in-force illustration showing the exact surrender value and the breakdown of basis versus gain. Fourth, model alternative strategies: policy loans, tax-free under Section 72P, exchanges under Section 1035, or holding until age 59.5 to eliminate the penalty. Fifth, consult a tax professional to model the full federal and state liability before you sign anything. The tax code rewards those who study it before the surrender, not after.